So we're going to take a twist on aggregate demand in this particular video. What we're going to do is build up an aggregate demand curve, which if you've seen in textbooks usually looks something like, again, we'd have a price level here and a level of output here, and they'd give a long list of reasons for why this would be. In other textbooks you'll see this done in growth rates. What we're going to do is convert this for an output gap approach, as I've been taking in these previous videos. So let's start with here. The intuition is that there's this relationship between the inflation gap and output gap growth. If we rise above that inflation gap, that will slow down the growth rate of real value. So we have this kind of decreasing output gap as we go along. So you can see this kind of already intuitively on an aggregate demand curve without thinking about the gaps either. Just the straight up growth rates, you should get kind of the same relationship here. Rising inflation slows the growth of value of real output. A rising inflation gap will also slow the growth of the value of the domestic currency for export spending. So there we have another kind of drag on the output gap with rising inflation. And rising inflation means consumers need to hold more money for purchases that contain less real value. So if we get kind of above that expected inflation trend, we end up having to hold on to more money, which could have gone to more groceries, more books, more computers, more songs off of the internet, that kind of thing. So what we're going to do again, if you look at especially the Marginal Revolution videos, which are fantastic, go with a straight up growth rate of this relating of the quantity theory of money from Fisher. We have the money supply increasing or decreasing, or the velocity of money increasing or decreasing, leading to increases in or decreases in inflation, where this delta M will be the money supply growth and delta V will be the velocity of that money, and it will just be kind of different places along the curve where we can push out through monetary fiscal policy or contract through monetary and fiscal policy or through unexpected shocks. Now we're going to take a Fisher's quantity theory look at the gaps. So what this will do is, on this side of the equation, I'm just bringing in a subtraction of the inflation target, which for the US case would be 2%, and then the potential output gap target. Now what you do on one side, you do on the other, right? So this is going to be a money supply adjusted for that inflation target. So a growth in money adjusted for the inflation target, and then a growth in velocity adjusted for this growth in potential output. And I'll call those little m, delta little v here. So we have a new kind of a monetary equation going on here, but really it ends up being the same graph and the same analysis. We're just looking at it from terms of the inflation gap or the output gap to line up with how I've set this up on the vertical axis, the horizontal axis, and we've defined our long-run aggregate supply curve to be that point where the output gap is 0, meaning we're on that trend in real growth, and the short-run supply curve is determined by those inflation gap shocks or inflation gap expectations. Okay, so the growth of money spent in the economy then is equal to this nominal output. So the AD curve is any combination of this inflation gap and real output gap that produces a given nominal output gap instead of the real output gap. So what shifts this? We can think of this in terms of potential movements of this actual curve. So the AD curve is just any combination, again, of output and inflation along these lines put into gaps. And we could have, say, a positive shock to this. I'll have a plus S, or a negative shock to this. So a positive shock in this case may be the incorporation of let's say a stock market and housing market boom. People are feeling more wealthy. They're buying more things. That pushes aggregate consumption out. The aggregate demand pushes out. A negative shock could be something like, again, as we've experienced recently, a global pandemic where people will social distance, spend less, go to restaurants less, that kind of thing. So that's a repeat slide here. The main driver of these expansions and contractions, or booms and recessions in the business cycle, is going to be this aggregate demand curve. And we'll see how those shocks will interact with our short-run supply curve and our long-run supply curve. Now, an expansion would be this pushing out of this aggregate demand. A contraction would be the pulling in of this aggregate demand. And this is the framework we will use to explain what happens during a recession or a boom.